Okay, I actually remembered to start the recording, which is a plus. Tonight we're going to be discussing Chapter 8 for Accounting 101. This is long-term investments and the time value of money. Chapter 8, I will tell you the journal entries about just the long-term investments are just typical, straightforward journal entries. You have to always go back and remember an asset, of which an investment is, would increase on the debit side. So if we were purchasing that asset for cash, then we would be decreasing our cash to do that. The other thing that we talk about with this are recognized and unrecognized gains and losses and the difference between those. So just as a little overview, as we get started, we will talk about 6 different learning objectives in this chapter. We will talk about analyzing and reporting investments in held-to-maturity debt securities. We'll talk about analyzing and reporting investments in available-for-sale securities. We'll analyze and report investments in affiliated companies using the equity method. We will analyze and report controlled interest in other corporations using consolidated financial statements. We will look at reporting investing activities on the statement of cash flows, and then we will explain the impact of the time value of money on certain types of investments. The concept of time value of money can be probably the most difficult for students in this chapter. So if you read your chapter, it started out talking about Intel, and in my face-to-face classes, I would open up the Intel annual report and we would review the financial statements and try to identify which types of investments the company held and if any were long-term. We would try to determine from the notes to the financial statements if those long-term investments were available for sale, held to maturity, or if they perhaps had equity method in some consolidations with other companies' stock. With that in mind, we want to talk a little bit about the difference in stocks and bonds. Stocks are the equity that the investor owns equity in the stock of another company. If we go out to the stock market and buy stock in Procter & Gamble or General Electric or General Motors or Walmart, wherever we're buying stock, then that is the stock on the open market, or we're buying ownership in the company. If we buy bonds from a corporation, then we are actually loaning them money. It's just a loan. Is a long-term payable of which they pay us back. So the investor is the person who owns the stock or the bonds. The investee is the equity or the entity that issues that stock. So it's the company whose stock you purchase. With bonds, the debtor is the entity that issues those bonds. Okay. I know that most of us don't actually see a print newspaper every day anymore. I mean, I even pay for a print newspaper to be delivered, which it seldom arrives at my door and or in my mailbox, and their theory is, well, you can get to it online, so if we don't deliver it in your mailbox, it's not a problem anymore. I don't know if you guys have run into that. But at any rate, in the paper, you can look out at the stock markets and you can see what stock did in any particular day. And the slide that you have in front of you now has Intel. It shows the amount dividends are paying, the amount of volume of stock that was traded, the closing price of the stock, the high the stock sold for in a 52-week average, and the low. There is a question on the final exam that asks about this. I don't think there is on the second exam that you're getting ready to take coming up, but there is one on the final exam about understanding what these numbers mean. You don't have to do any calculations. It's a question you should be able to answer, but just to give you a heads up. When we go to report these investments on the balance sheet, we have short-term or long-term investments. Remember that short-term investments are treated as current assets. They should mature within a year. They are often called trading securities or held to maturity securities or available for sale. To be listed again as a short-term, they must be liquid. Liquid meaning we can convert them to cash very quickly. And we must intend to convert the investment to cash within 1 year or use it to pay a current liability. Notice the word intent, or the intend. We record investments just like we record liabilities. We record them at how we intend for them to be used. We might intend for an investment to be a short-term investment, but then we don't cash it in a year. If I would go out and I would purchase stock, and at the end of the year or anytime during the year it had just lost value, if I could afford to sit on that stock, I'm going to sit on that stock. It will become a long-term investment, but it's recorded as a short-term. That's perfectly all right. We can go in and reclassify that. That's out of scope of this class, but you can reclassify your assets and your liabilities if you need to. Investments on the balance sheet are shown under, first we would have current assets, then our short-term investments, then our long-term investments would be listed with the section right before our property, plant, and equipment. So basically, when we have a classified balance sheet, we've got 4 classifications of assets. Again, we've got the current assets, the investment section, property, plant, and equipment, and intangible assets. So basically 4 sections on the balance sheet under assets. Okay, let's talk about the actual chapter. So first, analyze and report investments in held to maturity debt securities. When I'm the bond holder, it means I have invested in bonds. Can anybody type into the question box? Can you type what an investment in a bond would mean? Do you know what a bond is? Oh, Tracy. I'm over here reading my question box. Let me see if I can get Tracy on board here. Yes, I did say, Tracy, that a bond is a loan to the company. Okay, Tracy cannot hear me. So a bond is actually where a company needs to raise a large amount of money, so they would go out and they would go usually through an insurance company and create a contract of many, many, many individual bonds. So if I needed to raise $1 million, I would then set that out maybe in amounts of $1,000. So small investors like me or you could buy $1,000 toward that bond and earn the interest on that. And then once we have these bonds, I'm sorry, I'm trying to help Tracy see if she can figure out what's wrong with her sound as I'm trying to talk here. But once we have that bond, indenture, or bond contract set up into place, then as I said, there can be many, many, many investors toward that $1 million the company needed to raise. If you have any retirement funds, you probably have some bonds in that retirement, but you wouldn't loan the company the whole $1 million they needed. You would just loan portions of it. Okay, the speakers are working on your end. You just can't hear me. So at any rate, I'll move on with this. So the bonds are different than a note in that they are you have a portion of that bond. We used to deal a lot in Series E savings bonds and Series I savings bonds before the economy tanked a little bit. It was a good way for people to invest small amounts of money. That's not so much so in this world anymore. The interest rates are shot with that, but you can still earn some decent interest with bonds. So again, if I'm the investor, then I have an asset, an investment in the bonds, and the corporation who I'm buying that bond from would then have a bond payable, which behaves like a long-term note payable, except we have to amortize what's called the premium or discount as we go forward. The investor also will earn interest revenue, and there will be interest expense for the corporation. Okay, I'm going to go now. I'm going to quit dilly-dallying with questions I can't solve. In order to report this held-to-maturity bond or debt securities, we would need to report it at its amortized cost. Interest received semi-annually, usually. It usually is issued in $1,000 denominations, as I said. The price is quoted as a percentage of par, or it can be. So if we see something that says you purchase bonds at 96, that would mean that we bought them at 96%. So for a $1,000 investment, we would pay $960. If it were we purchased them at 103, then that means we paid 103% for those, or instead of $1,000. So we paid a premium price. So why would we do that? The fluctuation in the market value, the market interest rates, is what would make that a difference. If the market rate is higher than the base rate of interest, the rate that's stated on those bonds, then it would sell at a discount. Why? Because if you had the chance to invest, not me, but if you had the chance to invest $1,000 and you could get it to pay 10% interest versus 5% interest, wouldn't you invest at the 10% interest, all else being equal? And in what happens here, that means is you're going to just earn. If you purchase these bonds, you're going to earn the base rate of interest. That's why you wouldn't want to pay the full $1,000 for the bond, because you're only going to earn the face percent of interest, so you're going to pay less, but earn the face interest on the full $1,000. And it basically levels out the playing field, because these companies have spent thousands and thousands of dollars to get these bond issues ready to sell, and they had to put a stated interest rate on that bond when they did the contract. And then if the market changes drastically, it could make those bonds unsellable if you didn't have some way to level out the playing field and make a market for them. So in the same theory, if the market rate of interest is less than that base rate, you would pay more than the $1,000 for that bond, because you're going to get that interest rate just on the $1,000. Basically, you come out you would have earned the market interest rate on that investment, regardless of what the face rate is. When I'm reporting investments in held-to-maturity debt securities, I want to initially record that investment at cost. So if I paid more than face value, I'm going to still record it at more than face value. If I paid less, I would record it at less. So that would be my premium or discount. The interest revenue would be recorded at the semi-annual interest payment date. They keep saying that it's semi-annual. I want you to keep in mind that bonds can pay interest annually, and they can also pay interest quarterly. It's not always semi-annual. You amortize the premium or discount, and if you remember amortization, you talked about in Chapter 7 a little bit, and in Chapter 7 that was used when we were amortizing intangible assets. Well, amortization behaves kind of like depreciation, as you learned. So it's the gradual using up of that premium or that that discount to bring that bond back to its face value. That's the process that we're looking at when we amortize. Okay, and so again, the carrying value is adjusted back toward the face value, and then the face value is received at maturity. So when we were talking a little earlier about $1,000, if we had issued that bond at 96 and we would have had a discount of 960, we would have had a discount of $40 that over its life we slowly added that to the interest expense if we were the company, interest income if we were the investor. So here we have a little illustration. We purchased 10,000 of 6% CBS bonds at a price of 95.2 on April 1st. We intend to hold the bonds until the maturity date of April 1st of 2018. The interest dates are semi-annual on April 1st and October 1st, and the bonds will mature on April 1st, 2018. They will have been outstanding for 4 years. So we actually purchased them on April 1st, so how much would we have paid for these bonds? The first calculation is the bond issue price. We would have had 10,000 at a price of 95.2. So 10,000 times 0.952 is 95.20 as our held to maturity investment, and we would pay cash for that amount. We record the interest receipt and the amortization of the discount on the first interest date. Notice that we recorded the interest, the cash interest amount is the 10,000 times the 6 for 6 months, $300. Our interest revenue then would be $300. We need to amortize then our interest revenue to record the additional revenue, and that is our $60 of interest that we received as we worked down this discount, which was the 480 divided by 48 to get to the 60. Okay. 48 is the 48 months times 6 months to get to 60. We purchased 10,000 of 6% bonds at a price of 95.2. Did I just go all the way backwards? Oh, this is the year-end adjusting entry. We needed to record the December 31st entry as interest receivable because we are not going to collect this money yet. And we need to amortize its portion, 3 months worth. We report this on the balance sheet. We will show under our interest receivable our $150. We have our held to maturity securities or investments. They're showing it at our purchase price plus our 2 amortized amounts added back to increase that to $96.10. And then on the income statement, we would have interest revenue to report. And again, note, this is the important thing that we are learning with this chapter. What we're learning with this chapter is that by the end of the bond 4 years, the maturity date, the carrying value will equal face value, because this $90 was 9 months so far of interest. So we'd have another $30 when we got back to April 1st. And so we'd be up to $96.40. And then we would keep increasing that by $60 every 6 months. By the end of 4 years, we're up to the $10,000. To report investments in available for sale securities, we will keep in mind that depending on how much we own is how it's reported. So if we own less than 20%, we report that as available for sale methods. We look at their fair values or fair market values and record them. Well, let's look at one of these first, I guess. We have 1,000 shares of Hewlett-Packard common stock. The market price is $44 per share. Intel intends to hold this investment for longer than a year and therefore treats it as a long-term available for sale security. Intel's entry to record this investment is our investment in the stock at actually 1,000 shares at what the market price is, and we pay cash. If we receive a dividend on this stock, then we have cash and it's dividend revenue. Keep in mind that GAAP, generally accepted accounting principles, require available for sale security to be reported at their fair value as of the balance sheet date. So this is one of those rare occasions where we need to record an unrecognized gain or loss if we have not sold the stock, but its value has changed. So they're quoted prices in active markets for identical assets. We need to look up and if our HP stock had gone up from $44, then we will have an unrealized gain. If it's gone down, we will have an unrealized loss. We have estimates based on prices for similar assets. If it's not something that we can find identical, then we need to base it on a fair market value of another similar stock. And we base it on the company's own estimates as well. If we know we have an asset that has decreased in value, then we can, which is an investment, then we can reduce that. So we have our carrying amount of the investment, our original cost of the investment. We have a debit balance in allowance to adjustment investments or balance if the fair market value is greater than cost, or a credit in the allowance to adjust investments to market if it's a decrease in fair market value. So in this case, our stock went up to $46.50, which was an increase of $2,500. So we have an allowance to adjust our investments in our fair value stock adjustment, and we have an unrealized gain. It's unrealized because we have not sold the stock. Keep in mind, too, that this allowance to adjust investments is a contra account. It's contra to the investment itself. So, but as you saw, we either debit or credit it. We debit it if we have a gain. We credit the allowance account if we have a loss. Okay, looking at some T accounts, we had our initial investment of $44,000. We now have our adjustment, our allowance to adjust the investment account, and that makes our carrying value $46,500. Let me go back up a minute here. So if the fair value increases, the allowance is debited. If our fair value had decreased, we would have credited. And these unrealized gains and loss are reported on the income statement as other comprehensive income. So they're not reported above the net income line. It's an additional portion of your income statement below the net income. So unrealized gains or losses on investments cause a change in owner's equity. Again, it's reported as an element of accumulated other comprehensive income. It bypasses net income in your financial statements altogether. It's reported in a separate statement of comprehensive income or a section of income below the net income, which is what I just said, in a combined statement of income or comprehensive income. Here's an example of how we have our financial statement with our revenues, expenses, net income, and then our combined statement is showing other comprehensive income is our unrealized gain on investments, less any income tax. That would mean this $1,500 is shown net of taxes, and that gives me my comprehensive income. So if we decide to sell all of our Intel investment that we had originally, Intel sells our HP investment of stock for $4,300. If you recall, we currently had it sitting on the books for $46,500. So the first thing we needed to do was zero out the gain, the unrealized gain. We had put $2,500 in the gain and into the allowance account, so we needed to back that out. We reverse that entry out. Then we record the sale. And we had an actual loss, not an unrealized loss, an actual loss because we now sold the investment. So now this loss goes above the line in net income. It's no longer below the line in net income statement. It's above the line. It's an actual loss. Goes under other revenues or other gains and losses or other revenues and expenses on your financial statement. So see if you can type me in the answers to this one as we sit here. So suppose Intel Corp holds the following available for sale securities as long-term investments. They paid $85,000 for Coca-Cola, and $16,000 for Eastman Kodak. Their fair value as of December 31st was $71,000 and $12,000 respectively. Show how they will report these long-term investments on their December balance sheet. Can you type me out that answer? Tracy says she can. Or Tracy's hand's raised. Did you have a question, Tracy? If you did, you can type it in the box and I'll see if I can answer it. Okay. We'll report our investments as $83,000. Here's another example we can work through. if we journalize the following long-term available for security transactions at available for sale security transactions, we purchased 410 shares of California Fine Foods common stock at $35 per share with the intent of holding the stock for the indefinite future. We also received a cash dividend of $1.90 per share on the stock. At year end, the adjusted investment account fair value was $41 per share, and we sold their stock for $25 a share in Part D. So first, we need to record the available for sale. We have our investment. We paid $410, $35 a share. Spent cash for that. Second, we received a dividend of $1.90 per share. We have 410 shares. And okay, magic. We have 410 shares and recorded that as dividend revenue. We needed to record at December 31st. Our shares were now worth $35 per share, so we are going to have they were worth $41 per share, so we have an unrealized gain. I wasn't sure how we had a gain when I said these were $35. And then for Part D, we were ready to sell these, so we had to get rid of the unrealized gain, zero that out. And we sold them for $25 per share. We originally paid $35 per share, so we had a loss of $10 per share on that, and zero that investment off our books. If we buy in affiliated companies using the equity method, we record this a little differently. If we buy a large stock in another company, 20 to 50% of their investees' voting stock, then we have a significant influence over that investee's operation. The investment is initially recorded at cost, just like it was on the available for sale, and then the investor records its share of the investing net income and dividends. So that's a little different. So we have $490 million for 49% of IM Flash Technologies. We're going to do an equity method investment and pay cash for that. IM Flash Technologies reported a net income of $300 million. Intel gets to record 49% of that as their equity method investment because they own 49% of the company. So it increases their actual investment by $147,000, and they record revenue for $147,000. When the dividend is paid, that is going to take cash out of the actual investees, or they're going to actually get cash because dividends are received, and it's going to increase their investment. Remember, on the last method, we recorded it as dividend revenue. When we're using the equity method, we record it right into the equity method investment, or reduce the equity method investment because we got cash for that. Intel's equity method investment account at December 31st shows the balance of $539. Okay. And we just list it on under our assets as the type of investment it is. And then they sold 20% of their stock here. They purchased it at $490. They sold 20% of their 49%, subtracted out or their dividends, take it times the 20%, their cost would have been 107 in their equity method investment, and so their loss on sale would have been the 7.8. So that's what you call plugging a number. You plug in the numbers that you know, and then you plug your debit or credit as needed to make your debits and credits equal in the transaction. Another illustration, equity method. We paid $1,800,000 to acquire 40%. $650,000 was recorded as net income, and cash dividends were paid out of $450,000. So how do we record all of these items, and what is their ending balance? Record the investment first. We record the amount of revenue that is ours at 40%. The payment of cash dividends. We move from the investment to cash. And the balance is we have our purchase plus any earnings less any dividends paid to get the ending balance of $1,880,000. So if we are using consolidated financial statements because we have control, if we are buying the controlling interest of another company, we own more than 50% of the investee's voting stock. The investor can elect the majority of the board members. The investor is called the parent company, and the investee is called the subsidiary. Okay, so there are many investors who are the stockholders own Intel Corporation, and Intel Corporation owns McAfee Inc., which is a buyer's protector. The method of combining financial statements of all companies controlled by the same stockholders is called consolidated accounting. The result is a single set of statements. It gives a better perspective on total operations than individual statements. Typically, a worksheet, so in Excel, is used to combine the parent and sub-companies, and the intercompany accounts are eliminated. Okay. So here's an example of a worksheet for consolidated balance sheet. We have the parent company, any subsidiary company. We eliminated any item that was the parent companies alone. To come up with the grand total of 581. Why does the consolidated stockholders' equity exclude the equity of the subs corp? It's because the stockholders' equity of the consolidated entity is that of the parent only. Okay. Sounds like a quiz question. To include the stockholders' equity of subsidiary as well as the investment in the subsidiary on the parent's books would be double counting. We'll be adding that same money in twice. You should have picked up on Goodwill in Chapter 7 as well. Goodwill, we've talked about it before, Chapter 7, but goodwill arises when the parent pays more to acquire a subsidiary than the fair value of the net assets, and it is recorded as an intangible asset. You learned that goodwill is reviewed annually to see if its value is still as stated on the balance sheet, and if it's not, then you amortize it at that point in time. I think it's it's easy to think about goodwill as more as if you were going to buy a local pizza shop and that pizza shop rented the building, so they didn't own the building as assets, but they did own maybe a pizza oven and some tables and chairs and some other kitchen equipment, and that equipment was deemed fair market value to be $100,000, but the business was for sale for $150,000, and you chose to buy the business because of the revenue it generated, then you would have $50,000 of goodwill on your balance sheet at that point in time because you paid $50,000 more than the fair market value of its assets. Non-controlling interest arises when the parent company owns less than 100% of a subsidiary stock. You record it as a separate account in the stockholders' equity section when that happens. So if we have a parent company that owns all of its stock, and 60% of the stock in subsidiary 2, during the year ended, the parent earned a net income of $330,000, subsidiary 1 earned $150,000, and subsidiary 2 had a net loss of $100,000. The parent company would report net income as $420,000. Because they owned 100% of subsidiary 1 and only 60% of subsidiary 2. So, if they own a portfolio of bond and other debt securities as well as equity securities less than 20% that it intends to hold long term, they will record that as an available for sale security. If they own 20 to 50%, they will record it as equity, and if they own more than 50, they will record that as a consolidation. And if they own bonds that it intends to hold to maturity, they will use amortized cost to record that. As most of you know, from a global perspective, many U.S. companies conduct a large part of their business abroad. Intel, General Electric, Pepsi, among many, many others, are more active in other countries than they are in the United States. In fact, Intel earns 84% of its revenue outside the United States. Exhibit 8-8 shows the approximate percentages of international revenues for these companies. So Intel has 84% of international revenues, General Electric 54%, and PepsiCo 40%. It is interesting, when I was in Kabul, Afghanistan, the last few weeks, there were Pepsi was there were Pepsi advertisements, there were Pepsi billboards, absolutely fascinating to me that you see English billboards in Kabul, Afghanistan, but they most definitely are there, and these companies are out there advertising and selling product all over the world. So how does that affect our foreign currency and exchange rates? Because when we have businesses that are doing international business all over the world, they're receiving and paying in a foreign currency often. So how do we measure the one nation's currency against the other? We use the foreign currency exchange rate. Conversion for an item in one currency to another is called the translation of that currency. Your textbook gives you some currency rates for different. Find the page. I can refer you to the page. On page 447, it talks about the conversion to the U.S. dollar for the real, which is from Brazil, the Canadian dollar, the euro, the pound from the United Kingdom, the yen and the yang from Japan and China, and the peso from Mexico. Again, you know, just having come from Afghanistan, it was the Afghani, which conversion rate was, you would divide however many Afghani it was by 58 to get how many dollars it was. And that's, you know, you do the conversions. These companies report their income statements or their financial statements in the American dollar, but the point is that they are doing business in different currencies as time goes along. So what does affect exchange rates? The ratio of imports to exports and the rate of return in those capital markets. So the currency rate changes daily. I mean, it changes more than daily, but it's, you usually convert at a daily rate. So if exports exceed imports, it increases the demand, drives up the price of the currency. If imports exceed exports, the supply increases and currency prices fall. If the rate of return in capital markets is high, it increases international investments and the demand for the currency. So for instance, and I will tell you, you'll run into some multiple choice questions about these, about currency. That's really about the extent of what you run into is some multiple choice questions. So foreign subsidies, financial statements are translated into US dollars. Assets and liabilities are at current exchange rates. Stockholders' equity is at historical exchange rates. The difference causes an out of balance condition, and the translation adjustment is needed to make that balance. This is just, again, information, not something for you to get all caught up in. So if Intel has an Italian subsidiary whose financial statements are expressed in euros, Intel must consolidate the Italian subsidiary financials into its own statements. When Intel acquires the Italian company in 2009, the euro was worth $1.35. When the Italian firm earned its retained income during 2009 through 2014, the average exchange rate was $1.30. On the balance sheet in 2014, a euro is worth only $1.20. So this shows how we would translate, this next slide shows how we would translate into dollars. So if we had 800,000 euros, we would take it times the exchange rate, and that would be $960. Okay. And that's just how we convert it. Then we would have a foreign currency translation. Again, you notice that is under the other comprehensive income. Okay, here under the other comprehensive income. How do we report investing activities on a statement of cash flows? Again, we're heading toward our cash flows chapter pretty quickly here. How do we report? We report it as under the investing activities. If I purchased investments, then I have spent money. If I sold an investment, money comes in. I have more cash if I sold an investment. I have less cash if I purchased an investment. That's how I report it on my statement of cash flows. Time value of money. The time value of money, the concept is that money earns interest over time. Interest is the cost of using money. To borrowers, the interest is a fee. To lenders, the interest is revenue earned. I like to introduce present value and future value in the classroom. I have these play $100 bills that I hold up, and I ask my students, would you rather have this $100 today, or you want me to keep this $100 for you and I'll give it to you a year from today? And it's always interesting to me that several students believe that they would rather I hold that $100 for them. and give it to them a year from now, because otherwise they won't still have it. Or some of the reasons why, I mean, that's the biggest thing. They have trouble saving. So if I keep it, then they'll have $100 a year from now. And I think, okay, I'll do that. I'll keep it and I'll give you this $100 a year from now. That's fine. And then we talk about things such as, well, why would you rather have it today? For those of the students who said, I'd rather have it today. And a lot of their reasoning is, well, because you might not be willing to give it to me a year from now, or maybe you won't have it to give to me a year from now. And, so then this leads us into the conversation of how a dollar in hand today is always worth more a dollar than receiving a dollar sometime in the future. And then we got into a conversation about, then I'll go on and I'll say, so how many of you are debt-free? Well, I mean, maybe if I have a 18-year-old in the class, they're debt-free, but as you are aware, not every Ivy Tech student is 18 years old, so most of the people are debt-free. So I started saying, well, what are the interest rates you pay? And actually, I was talking to my class yesterday, and I had 2 students who pay over 20% interest. One for a car loan and one just says her credit shot. And I said, and both of those students would have rather had the $100 a year from now than today. And I said, you could have stopped that 25% interest. And so that's always fascinating to me. But a dollar in hand today is always worth more than a dollar at some point in the future, because you can either stop interest or you can earn interest with that. And that's my little personal finance jab to this. So again, with the time value of money, the concept is that money earns interest over time. If I'm the borrower, it's costing me interest because I have to pay that interest to someone else. If I am the person who loaned that money, I'm getting paid interest. So how does future value work? Future value is how much would I earn at some point in the future if I invested a set amount of money today. So if I know how much money I want to put in today, then how much will it be worth in the future? Suppose I invested $45.45 in corporate bonds that pay 10% interest each year. After 1 year, the value of your investment has grown to $5,000. Because I had a present value of $45.45, I earned 10% interest on that. To get to my future value of $5,000. I need 3 points to calculate future value. I need to know the amount of my initial payment or the receipt. I need to know the length of time between the investment and the future receipt or payment, and the interest rate. I compound interest. It's interest that you received on the interest that you have already earned. So when you hear someone, if someone asks you if you wanted to borrow money, you would want to borrow money using simple interest so that the interest you didn't have to pay interest on the interest that had accumulated. But if you're going to save money, you would like to have compound interest, not simple interest. So here's an example of how interest compounds. If I started with my $45.45 and I was going to save this and have this investment for 5 years at 10% interest, year 1 would earn $455. Year 2 would earn $500 because I am now earning it on the interest that I earned. So my interest keeps earning interest, and what started as $455 interest is now up to $666 interest a year, which is really good. You can't get 10% on anything in today's market, but if your interest rates are good, it really grows fast. Okay. That's future value. So what's present value? Present value is how much would I have to invest today to get to some set amount in the future. That's useful if I want to know I want to buy a house at some point in the future, and I know I need a down payment for $500. Or $5,000. I could calculate how much would I have to put in out of my tax refund this year, so that in 5 years from today I'd have enough to buy that house. Something along that line. But it's a value on a given date of a future payment or a series of future payments, discounted to reflect the time value of money. We often hear this called discounting. To simplify calculations, we can either use the present value tables or Excel software, and you can use it for either a single amount or an annuity. I do want to talk a little bit about the tables in your textbook. The tables are on page 452 and 453. You will notice a couple things about these present value tables. Present value of a lump sum or present value of a dollar. If I'm going to invest money one time, I would use the present value of a dollar. If I'm going to invest so much each month or so much each year, I would use the present value of the annuity for a dollar table. Other things that you need to know as we get ready to move forward, if you could look at the tables, that would be great, but if you can't, I can get to them here in the slides pretty quickly. This is just more illustration of how we're doing the last computation. So if this is the present value of the dollar, or you may hear it called the present value of the lump sum, then if I was earning 10% and I was going to do, I knew I needed, or my future value is going to be $5,000. How much do I need to invest today? What's my present value of that $5,000? My present value, depending on the number of years, so if it's 1 year, it's going to be the 9.90 for my factor. I would take that times my 5,000, and there's my 45.45 again that we put in that first year to get to 5,000 at the end of a year, if you recall that. Let me back up again. So in this case, we had 10% interest, and it was for 1 year. If I had something that was going to be 7% interest for 3, I'm saying years, periods, for 3, it would be a factor of 0.816. If I had something that was going to pay semi-annual interest and it had a 2-year maturity and is going to pay 8% interest, I would have to use 4% interest for 4 periods instead of 8% for 2 to get the correct answer, because it would be earning interest every 6 months, and then that interest would be earning interest. So an annuity, then, I said, was a series of payments. So in that case, we would be putting $10,000 in at the end of the period each year for 3 years, assuming we can get 12% interest rate. We would be using the present value of the ordinary annuity of a dollar, 12% column, and for 3 years. So our factor would be 2.402. So we were going to be putting $10,000 in. So we would take 10,000 times the 2.402 to get the 24020. So if I put 24020 in, I will get back $30,000. $10,000 each year for the next 3 years. So the face value of the bonds is $100,000. The face interest is 9%. The bond pays 4.5% interest semi-annually. 4.5 plus 4.5 is 9%. So the market rate of interest is assumed to be 10% annually. That means 5% rate is used to compute the present value, again, because they pay interest semi-annually. And the market price of these bonds is $96,194. How do we get the $96,194? We have to compute the present value of the principal, $100,000, times its 5% for 10 periods. You looked that up in your lump sum factor and you found that to be 6.14, and you multiply it and get 61.4. Then we need to compute what is our actual cash interest payment. If it's going to pay cash interest of 4.45%, because it told you that its face value was 9% interest, it's 45,000 times. Notice that we use the actual market rate to get the factor. So it's the market rate to pull the factor, but we calculated the cash interest using the actual interest rate or the stated interest rate. So that's important. Okay, let me back up here a minute. What if I wanted to do this same entry in Excel? And the book does show you Excel, and a lot of your homework you have to use Excel. So let me pop up Excel just to demonstrate this. So if I needed to use let me do this. Okay. If I'm going to use my functions, I would need to use present value. It pops me up the table. I said I need to use my actual market rate. My number of periods was 10. My payment amount is the actual interest payments. We calculated the interest payments at $4,500. My future value is $100,000. I actually need to put these in as negatives. Because it is cash going out. And I can just say okay. And I got 96,139.13. Why did I get 96,139.19 when the tables gave me 96,149? Because Excel is more accurate. So what I was trying to point out to you here without actually saying it first is that you want to make sure that if your My Accounting Lab tells you to use the tables, that you use the tables. If it tells you to use Excel, you use Excel. Otherwise, you might be really, really confused with that. Okay. So remember, the important factors to remember is that you use the market rate of interest when you are calculating the present value, but you have to use the base rate of interest to calculate the cash interest because you would be getting paid the cash interest. So in this case, this bond is being sold at a discount. You would pay $96,149 for this $100,000 bond as your investment. You would receive every 6 months $4,500. And then at the end of the 5-year period, you would pay back, or you would be paid $100,000 for this. And that difference between the $96,149 and the $100,000 makes up the difference in the 1% of interest that you were not getting as cash interest. Any questions?